Okay, good morning. It is 10 a.m. and we want to officially welcome you to the Washington County Chamber of Commerce weekly webinar series. Thank you for joining us. Today, we are very fortunate that we have our previous board chair and still serving in the capacity of past chair of the Washington County Chamber of Commerce Board of Directors, Amanda Stolz. She's a partner at Seidel Schroeder and a certified public accountant. And so we're very fortunate to have her with us today, and she's going to talk about the tax implications of the CARES Act, which I know is something that business owners are interested in learning more about. So with that, I'm going to turn it over to Amanda. Amanda, thank you for joining us.
Thank you. Good morning. Well, today I'm going to cover, as Wendy said, some of the, I used the word implications when I was discussing it with them, but it's really more considerations because there's not too many things that are bad in the CARES Act. Most of it's meant to help people. So I'm going to make sure, Wendy, can you see my screen?
Yes, ma'am, I can.
Okay, good deal. Okay. So just to kind of give you guys a lay of the land so you understand how the presentation is going to go, I'm going to start off by covering the changes that affect individuals and give you guys an overview of that. Then we'll dive into businesses. I'm going to focus on small businesses since that's really who our members are. And then we'll go over some of the payroll tax incentives that are available. And then I'll wrap up with a brief discussion about the loan programs. They did a program last week. The webinar series was the SBA, and they went in deep detail on the EIDL loans and the PPP loans. So I'll touch on those, but my goal today is not to make you an expert on those by any means. And I know that they have that webinar recorded if you want to go back and reference that. Obviously, the first slide is a caveat that I am not giving you individual income tax advice. So please consult your tax advisor with your specific situation. But I do want to give you some information that I hope is helpful today. So let's start off with everything that's near and dear to everybody right now is the advance payments and who's going to get the stimulus check. Some of you have already received it. The stimulus check is $1,200 for a single filer with income of less than $75,000. And it phases out at $99,000. So once you hit 75, you don't fall off a cliff, but you do lose some of that benefit. And then if your income is $99,000, then obviously you wouldn't be receiving a stimulus check. If you file head of household or married filing jointly, head of household is $1,200, but that income cap starts at $112,500 instead of $75,000. And then for married filing jointly, that phase out starts at $150,000. The phase out is 5% of your adjusted gross income that exceeds those thresholds. And then please note that if you are a non-resident alien or a child who could be or is claimed on your parent's tax return, you would not be eligible for that stimulus check. You'll be receiving an extra $500 per qualifying child. And know that the definition of qualifying child really is just who we get to take the child tax credit for on our personal tax return. So it's your son, daughter, stepchild, foster child, brother, sister that you get to claim that's a descendant of you, that's under the age of 17 at the end of the year, that lived with you for more than half the year, and that you provide over half their support. They must be a U.S. citizen, a U.S. national, or a U.S. resident, and they must be claimed as a dependent on your return. And then, of course, they need to have a Social Security number or other identification number. The actual credit is a function of your 2020 income that would be taken on your 2020 tax return. The advance piece of that is that they can base it off of your 2018 or 2019 tax returns. So this is a planning opportunity for you because if your 2018 income was over the limit, but your 2019 income is not, then you'll still get the benefit of the credit. Vice versa, if your 2018 income was under the limit and your 2019 would be over the limit, you may want to hold off on filing your 2019 tax return to make sure you get the benefit of that credit. There will be no paying the credit back if you phased out on one year and not the other and you receive the credit. And then know that there has been some questions. We've had several phone calls about people who received the credit and the taxpayer was deceased. If you're one of those people, one of those relatives, you should be sending those checks back. So those people should not have received those checks. If you want to know where your payment is, you can go on to irs.gov, and right there on the front page of irs.gov, there is a button that says Get My Payment. And that will walk you through whether or not your check has been mailed and let you know where it's at. You will need your most recently filed tax return in hand before you log on, because they're going to ask you some questions about income. They're going to ask you your address, date of birth. So just be prepared to key that information in. Another provision of the CARES Act is the special rules for retirement funds. So some of us are in need, times are tough, and we need access to our 401k or IRA. The normal rule is if we are under the age of 59 and a half, anytime we tap into those funds, we have to pay a 10% penalty in addition to our income taxes. So it's usually quite a hefty price to pay to tap into those retirement funds. So Treasury has come out and said, hey, we know that some people may need to access those funds. We're going to let you take distributions of up to $100,000 from those funds if you meet one of these requirements. Those requirements are in the middle of this slide. You've been diagnosed with COVID-19. Your spouse or dependent is diagnosed with COVID-19. You've experienced adverse financial consequences because of quarantine, furlough, you've been laid off. So if you meet any of those qualifications, you should be able to take a distribution from your IRA or 401k or tax deferred vehicles and not have to pay that 10% penalty. But please note that they don't do away with the income tax liability. They will allow you to spread that income over 3 years so that you don't have all of that tax hickey in 1 year, but you still will be required to pay the income tax piece on that. And the thought process is when you deferred those monies, you didn't pay tax to begin with. So they're going to get the income tax. They're just going to waive the 10% penalty. In addition, they've given some flexibility for borrowing money from your retirement accounts. Just know that that is a plan-by-plan basis. So not all plan administrators allow for you to borrow from your 401ks or other tax deferred plans. So you'll need to reach out to your HR department on that and see if that's an option. Another provision is the waiver of the required minimum distribution. There's currently a law in the tax code that says when you reach 70 and a half if you were born before July 1st, 1949, or 72 if you were born after that date, that says you have to start pulling those monies out of your retirement accounts. Remember, those monies are tax deferred vehicles that are parked there for a future date, and the IRS doesn't want you to leave those deferred forever. And so they have what's called a required minimum distribution. Part of the CARES Act waives the required minimum distribution for 2019 with the thought process that the market's low. We don't want you to have to pull that money out while the market's low. So we're going to let you waive that required minimum distribution this year. They've also allowed an additional deduction for charitable contributions. So know that in 2018, they doubled the standard deduction. So normally when you're figuring out what your deductions are on your tax return, you take your property taxes, your mortgage interest, sales tax, you take charitable donations, and you add all those up and you compare that to the standard deduction. The standard deduction for 2020 is $12,400 if you're single and $24,800 if you're married filing jointly. Well, if I add up all of those deductions and they're under my standard deduction, I would take the standard deduction. So I'm not really getting any benefit for the charitable donations or the property taxes or the mortgage interest. And so part of the CARES Act gives up to a $300 deduction against gross income for those charitable donations. So not a huge deduction, but if you're one that doesn't get to itemize, it's certainly a benefit. And that's everything that relates to the individual tax side of things. Are there any questions at this point?
I don't see any, Amanda.
Okay, well then I'll keep going. Let's talk about some of the business tax provisions. There is a deduction allowable for employers if they want to provide a student loan repayment to their employees on a tax-free basis. Now, know that normally an employer can pay for anything they want for their employees, except that oftentimes those payments become income to the employee. So it's not as much of a benefit when they have to pay taxes on it. This provision allows them to pay up to $5,250 annually towards their employees' student loan accounts, and then they would not have to pay income tax on that amount. And the individuals receiving that assistance are obviously they're not allowed a deduction for the interest expense on that, but they also don't have income. So it's quite a nice perk. This is a qualified improvement property. That's one that's kind of hard to understand, but know that prior to 2018, if you leased property and made improvements to the property, oftentimes that property was depreciated over 15 years. There was a tax law change that happened for 2018 that made all of that property 39-year property, meaning you would have to spread that cost over 39 years. The perk to it being a 15-year asset is that you could take what's called bonus depreciation and really accelerate your write-offs. So it was an unintended consequence that for 2018 and 2019 has affected how fast people could depreciate those leasehold improvements. So part of the CARES Act, they fixed that glitch and said, hey, we really meant for that to be 15-year life, and we'll make it retroactive. So you can amend a tax return or correct it on your 2019 or 2020 tax returns to catch up all of this depreciation. And those numbers oftentimes can be quite large. So if this is something that impacts you, I would encourage you to reach out to your tax preparer. Another part of the Tax Cuts and Jobs Act, which is the law that was passed for 2018 going forward, is they were going to limit the amount of loss carry forward. So if you had a bad year and you had a large amount of losses carrying forward to future years, they were going to limit the amount of losses that you could take to $500,000 for married filing jointly and $250,000 for all other taxpayers. Part of the CARES Act is removing that limitation for 2020 and 2021. Another change that was made as part of, and I want to explain this chart to you, so it shows pre-Tax Cuts and Jobs Act, so that's prior to 2018. Then it shows post-Tax Cuts and Jobs Act, so that would be 2018 going forward. So that's the law that we were under in that middle section prior to the CARES Act. And what this says was if I had a loss, I could carry that back to prior years and get some money back that I had paid on prior year income taxes. Well, the Tax Cuts and Jobs Act, which is that middle section that you're looking at on this screen, says, hey, we're not going to let you carry anything back anymore. And in an effort to stimulate the economy, the CARES Act says, hey, we're going to let you take those losses and we're going to let you carry them back 5 years. So remember, 5 years back, we were at a much higher, those tax brackets looked quite a bit different. And so you could possibly take losses that are incurred this year in a time when things may not be so great to a tax year when you paid a higher tax liability. So that's what this slide is illustrating. Another limitation in the Tax Cuts and Jobs Act, they wanted to limit the amount of interest expense that businesses were allowed to deduct if they had a lot of debt on their books. And so it's basically a limitation that says, hey, we're going to only let you deduct up to 30% of your interest expense. And they waived that and increased it to 50% for 2019 and 2020. Now note, because there were a lot of partnership returns that were filed when this law passed, there's some nuances that come into play if you're actually filing a partnership return. So that's not across the board for all entities, but if you're one of those that was experiencing some interest expense limitation, they've lifted some of those requirements. And that's it for the business section. Shay, are there any questions on that?
Questions. Yeah, there's a little bit of a delay on the our viewers end. That's just typical. So there might be some trickling in here shortly, and I'll just jump in and let you know if I see any.
Okay, gotcha. Okay, let's dive into some of the employer payroll tax incentives. And there's quite a few out there to help with payroll. Remember, the concept is they're wanting to keep people working as much as possible. And so they're doing a lot of creative things to help you be able to keep your employees on the payroll. The first one is the employee retention credit. This is a refundable payroll tax credit for employers that are affected by COVID. And so who qualifies for this credit? This would be an employer whose operations were fully or partially shut down due to COVID, or their gross receipts for any quarter were 50% less than the gross receipts for the same quarter in the prior year. Now, please note, if you're one of those people that was eligible to get the PPP loan, you would not qualify for this credit. The credit is calculated by taking 50% of the qualified wages paid to employees between March 12th and December 31st, 2020. And it's capped at $10,000 of wages per employee. So your maximum credit is $5,000 per employee, which is just 50% of the $10,000. Now, please note, while it kicked in March 12th, so technically you could take this credit for the first quarter, very few people were impacted where their gross receipts were reduced by more than 50% over the prior year quarter in that short amount of time. So you're probably looking at second through fourth quarters of 2020. Qualified wages, if you have more than 100 full-time employees, it only counts towards those wages to employees that are not working. But for most of you, you have 100 or fewer employees. And so you would count all the wages paid to all employees, as long as you're affected by COVID or your gross receipts saw a 50% reduction over the prior year's quarter. Those qualified wages do include the cost of providing healthcare coverage, so you can add in your insurance for that as well. And then know that those payments that were made under any kind of emergency sick, FMLA, or Families First Corona Response Act, which I'll cover on a later slide, those wages don't count for the employee retention credit. How do you get the credit? Well, obviously you have to identify the wages that qualify for the credit and track those in your payroll system. And that is taken by reducing the amount of your payroll tax deposits for the amount of that credit. In addition, if your payroll tax liability is not enough to cover that credit, there is a Form 7200 that you can file to get an advance of the amount of the wages that you're paying that qualify for that credit. Another thing they've done to help you out is the deferral of payment of your employer's portion of payroll taxes. So remember, when you pay your employees, they pay half the FICA and Medicare, and you effectively pay the other half. So this allows you to defer the employer's portion of Social Security to December 31st, 2021 and 2022. You would have to pay half of it in 2021 and half of it in 2022. But please note that this is just a deferral. It's not a relinquishment of those taxes. So you're really just kicking the can down the road. But it is an option if you're in a cash flow crunch. Now, also note that if you receive the PPP money, you could not take advantage of this. Early on in the CARES Act, they signed a law called the Families First Corona Response Act. And I would encourage you, if you have not looked into this, that you are aware of this if you are an employer. This is an act that says basically if your staff, any of your employees have been affected by COVID, they're quarantined to take care of a family member, they're affected by daycare, that you are required to pay them up to 2 weeks effectively of their pay while they're experiencing those symptoms now, or those situations. A lot of people think, well, I have 50 or fewer employees, and so I'm not subject to this. And that's actually not the case. The 50 or fewer employees is if you are in this would be detrimental to the survival of your company if you paid this. The Department of Labor has a great Q&A on their website. If you go to dol.gov, it will walk you through. These are when you have to pay your employees. If they're falling under this circumstance, this is how much I have to pay them. And so I've kind of used that as my cheat sheet anytime we're looking into that. Now, the employee will have to do some documentation to provide for you so that you know what you're paying for. But basically, you're paying them what they would normally make in a 2-week time period. So if they're full-time, it's capped at 80 hours. But if it's a part-time person, it's what they would normally make in a 2-week period. That's it on the payroll tax issues. Are there any questions there?
You can feel free to unmute your phone if you're on just the audio portion, or if you are on the video portion, there's a little question dialog box. You can click that and type in a question.
If you're not seeing any, Wendy, I'll keep going, and then if there's any that come up at the end.
I don't see any questions.
Okay. So I want to just cover some tax compliance issues and then touch on some of the loan programs as well. So please note all the tax filing requirements that were due after March 15th effectively. So your April 15th, individual tax returns, corporate tax returns, any of your estimated tax payments, those have all been postponed to July 15th. And so you didn't receive an extension, rather they just moved our deadline. So know that any estimated tax payments, all of that stuff has been pushed to July 15th. So there's no penalties or interest being calculated between April 15th or July 15th. Now, July 16th, we're back to the old way of doing things, and so penalties and interest will start to accrue. I also want to mention that most of the states, but not all of the states. So if you're one that has a state income tax liability for whatever reason, some of those have moved their deadlines, but not all of them. So just make sure you check with your CPA to see what the requirements are there. And real quick, just wanted to touch on some of the loan fundings that have been made available. The first wave of funding provided for the economic injury disaster loan. This was a loan of up to $2 million at an interest rate of 3.75% for businesses or 2.75% for not-for-profits that allows you to repay it at a period of up to 30 years. So if you were in a cash flow crunch, this was a great option for you to jump into. Eligibility was 500 or less employees, which know that all of these loans that we're covering are 500 or less employees. There are some loan options for those larger companies, but that's not part of the scope of what we're covering today. And then the use of these funds had to be basically your general operating expenses. The loan program is in place from January 31st to December 31st, 2020, and it waives personal guarantees on loans of $200,000 or less. It also waives the 1-year in business rule requirement. So know that SBA has a lot of great lending opportunities, but sometimes there's some pretty stringent requirements in place that make it not available to everybody. The concept of these loans is to make it more widely available and get the funds to those people that need them. The loan is guaranteed by the SBA, and it encourages payment deferments when appropriate so that you can extend your loan maturity. Then the loan that we've all heard so much about is the Paycheck Protection Program. And know that the whole purpose of this loan was to keep your employees getting paid. These are loans for people with 500 or fewer employees. And the loan was calculated or is calculated by taking 2.5 times of your payroll cost in the prior year effectively, with a maximum loan of up to 10 million. Now, the first wave of loans, the first amount of funding that was approved came through on March 27th, and that was 349 billion. Know that everybody rushed out to get their loans, and that funding ran out pretty quick. There was a second wave of funding that came through on April 24th, and that was another 310 billion. And so there are still funds available for those that need PPP funds. The concept of the funds is that it is meant to fund your payroll effectively for an 8-week time period in 2020. So from the time this loan is funded, you look at the loan, any of monies that it's used on in the next 8 weeks that qualify as payroll, rent, and utilities, with 75% of that applying to payroll, they will forgive this loan, and that is not required to be paid back. They did release the forgiveness application yesterday on the SBA website. It's several pages long, but it's not overly complicated. And so if you're one of those that was able to jump on board and take advantage of this, feel free to go out there and take a look at the forgiveness application. Now, please note that while the forgiveness of the loan has been specifically said that it's not income to you, meaning you won't have to pay taxes on the amount of money that you receive from your Paycheck Protection Program, they've also come out and said that you will not be able to deduct those expenses that you've paid for with those monies. And so I did see somewhere where somebody said, oh, well, this is costing me my tax rate effectively to take advantage of these funds. And I would encourage you not to think that way. If you were one that was able to take advantage of the Paycheck Protection Program, while you don't have income from the money that you received, you won't get a deduction. That's an in and an out. So I wouldn't let that discourage you from taking advantage of those funds if you were one of those that was discouraged by that news. We also have the Economic Injury Disaster Advance Loan. This came out as part of phase 2, and this was a great way to get you up to $10,000. It says in 3 days of the application, but I think some of that was taking a little bit longer. And this was for employers with less than 500 employees or sole proprietors and certain non-for-profits. You had to be in business by 1/31/20. And obviously you applied through the SBA's website. This was an advance of up to $1,000 per employee with a maximum of $10,000. And this was money that you didn't have to pay back. Know that if you do get to take advantage of the EIDL loans, that will reduce any PPP funds that you have forgiven. Another thing they did was enhance the unemployment benefits. The federal, they added an additional 13 weeks of unemployment, whereas the state provides 26 weeks. The federal gave a $600 per week increase for the first 4 months, and the state provides obviously a max of $465 per week. The federal also extended its unemployment to self-employment workers, whereas normally in the past, self-employment workers do not qualify for unemployment. They can now still apply through the state, but they're actually applying for federal unemployment. So that's a great way to get funds to people in a time of need. And that is everything that I have. I think I had 30 minutes and I'm right at 30 minutes. Are there any questions?
I'm not seeing any questions unless is there anyone that wants to unmute their phone and have a question, or you can again type in the comment section. We did get one comment that this is very informative and helpful information, but no questions.
Gotcha.
We do want to thank our sponsor, We Manage Properties today for bringing us this webinar. Without sponsorships, we couldn't make these webinars happen. So we definitely want to thank Melanie Horton and her team at We Manage Properties for bringing this opportunity for Amanda to be here today. So thank you.
Well, if you have questions and you're one that doesn't want to go out on a limb and ask them on this webinar, please don't hesitate to reach out to us at Seidel Schroeder if any of us can be of assistance. And then again, if you had questions on those loan programs, I would encourage you to go and listen to the webinar from last week if you didn't get to take advantage of it, because the Small Business Association did a great job with that presentation.
Yes.
If there's nothing else, thank you guys so much for having me today. I really enjoyed it.
Great. And this will be, the Chamber has a YouTube channel, and so Shay will load the webinar. It takes some time to do that, but we'll have that up and we'll be sending a link to that. So you will be able to access this at your leisure, and of course share the link with anyone that you would like to share it with. So it will be accessible by the afternoon. So thank you again, Amanda, for your time. Thank you to We Manage Properties, and thank you all for joining us today. We hope you have a great afternoon.
Amanda, are you available for one question?
Thank you.
Oh, I think Shay said we have a question that came through.
Sure. Please.
If your 8 weeks ends prior to June 30th, is FTE required? I don't understand. There's a typo in the question. Okay, if your 8 week ends prior to June 30th. I'm sorry, I don't understand the question. Oh no.
Can you read it the way it's written, Shay? It sounds like they're asking about the PPP funds with the 8 weeks.
Is FTE still required at June 30th? I'm sorry, I got it now. If your 8 weeks ends prior to June 30th.
So my understanding of what they're referring to is the look back period. So the concept of the PPP loan was to keep your staff working, and that's the concept of those funds. And so they're wanting you to maintain your full-time equivalents during that period. And the look back period ends on June 30th. I will tell you that the application, the forgiveness application, and I've got that right here, it is asking for employees at time of loan application and employees at time of forgiveness application. It does not reference the June 30th date. That being said, my understanding was June 30. So I would reach out to your lender with regards to that. The law referenced June 30. So I think you're going to be stuck with that June 30, even though the application isn't indicating that. They're wanting you to have your full-time equivalents at June 30, the same as it was prior to all of this. And you've got 2 time periods that you can look at on that. But I do think even if your funding ends prior to June 30, that you have to have those full-time equivalents in place. I could be wrong.
Okay, it looks like that they were pleased with that answer. So any other questions before we close out this morning? Okay, well, again, thank you. Thank you, Amanda. Thank you to We Manage Properties and thank you all for joining us. Have a great afternoon.
Thank you.